Hi, my name's Eric, and this is the Audible Local Ledger's reading of Barrons magazine for January 13th of 2025, a reading expressly for the visually impaired. We'll start with up and down Wall Street as we always do. Bond yields are rising. Why that's a problem for stocks. This is by Randall W. Forsyth. Is the stock market about to yield to reality? That is, yield as in the interest return on long-term debt securities. And the reality is that yields are headed higher as a result of real economic growth and inflation that continues to exceed most forecasters' assumptions, which in turn suggests fewer, if any, short-term interest rate cuts by the Federal Reserve this year. For stocks, higher bond yields imply no increase from price-to-earnings ratios, and possibly some contraction from current levels. And those P/E multiples incorporate optimism about another year of double-digit earnings growth. Add to those concerns the uncertainty of policies from the new Trump administration's fiscal and trade policies, and you have the formula for sharp sell-offs in bonds and stocks. These forces came to a head on Friday after the Labor Department reported much stronger than expected December job growth, which prompted a further recalibration in Fed policy expectations by traders and a further rise in medium and long-term Treasury yields. Non-farm payrolls jumped by 256,000 last month, about 100,000 more than economists' guesses, while the unemployment rate dipped by 0.1 of a percentage point to 4.1%. There were few nits to pick in the numbers, with only minor downward net revisions in the two previous months' payrolls. After the employment report, markets further lowered the odds of Fed rate hikes this year. According to the CME FedWatch site, federal funds futures are pricing in no cuts through June from the target range of 4.25% to 4.5% that was set at December's meeting, and a single trim of 25 basis points, which is 0.25 of a percentage point, by December. A month ago, futures were pricing in two 25 basis point cuts by mid-year, possibly a third by year-end. With the December jobs report, the only mystery is why the market's still forecasting cuts in the funds rate in 2025 and 26. Stephen Blitz, chief U.S. economist at T.S. Lombard, wrote in a research note on Friday. Expectations of monetary easing are based on the assumption of a return to 2% inflation, which won't happen absent a recession. That's unlikely given the incoming administration's and the Fed's shared inclinations to promote growth, he added. Instead, Blitz sees 3% real gross domestic product growth and 3% inflation. With no anticipated Fed rate cuts in 2025 and 100 basis points of potential hikes in 2026, getting to a 6% 10-year Treasury yield is, quote, far from a stretch, given history and the volatility that the Trump administration is bound to usher in. Treasuries are actually entering the sixth year of the third great bond bear market of the past 240 years, notes B of A Global Research's strategy team that's led by Michael Hartnett. Previous secular trade trends of rising bond yields spanned 1899 to 1920 and 1946 to 1981. They count the current bear market in lower prices and higher yields from the summer of 2020, when the 10-year bottomed at 0.56%. On Friday, the 10-year yield reached 4.77%. That's the highest since November 1st of 2023 and just above the 4.75 average since 1790 as calculated by B of A. Corporations have responded by bringing to market a heavy slate of $80 billion of investment-grade securities since the start of the year through Wednesday, before most markets were closed on Thursday for former President Jimmy Carter, compared with the average of $66 billion in corresponding periods in 2022 to 2024, says B of A. Corporate treasurers appear to be taking advantage of current financing terms before yields rise further. Rising bond yields are also an international phenomenon. Government yields are moving up in Europe, where growth is tepid and budget strains prevail, especially in France and the UK. Interest rates in Brazil have also been forced higher by debt concerns. In the U.S., higher yields present a tough hurdle for equities. The S&P 500 index trades at 22 times expected forward earnings, writes Jason DeSena-Trennert, head of Strategas Research. That heady valuation also presumes another year of double-digit earnings growth on top of yet-to-be-reported final 2024 numbers. Further, it's difficult to justify P/E expansion without a meaningful decline in long-term interest rates and another period of irrational exuberance as seen in the 90s. Trennert adds that odds of the latter might be greater than presumed, given the incoming administration's anticipated deregulation and more pro-business stance. It should be noted he has said he's open to accepting a position in the Trump administration. But given the struggles stocks have shown when the 10-year Treasury tops 4.5%, discretion may be the better part of valor in 2025, he concludes. With increased pressure on P/E multiples from rising bond yields, the fourth quarter earnings season, about to start, takes on even greater importance. As always, the outlooks for future quarters presented in earnings calls count more than the numbers for the quarter just ended. Along with weak growth abroad, higher for longer U.S. rates present risks for growth in equity valuations. Just a few stocks drive all the returns of the equity market, while the vast majority matter little. Indeed, most of them just detract from gains produced by the leaders. This isn't about the magnificent 7 behemoth tech stocks, which have accounted for the lion's share of equity returns over the past 2 years. A study of U.S. stocks returns over nearly a century find that the median stock actually lost money since 1926, even while a dollar invested across all stocks on average grew to $229.40 by the end of 2023. Of course, the concentration of outsized returns in just a few stocks isn't new, and in fact appears to be the norm over the modern history of stock markets that began in the first roaring 20s of the last century. All this comes from recent research by Arizona State University finance professor Hendrik Bessembinder. Examining results from 29,078 common stocks in the database of the Center for Research in Security Prices, or CRSP, CRSP, going back to December 31st of 1925, he found that most stocks lost money and that a few big winners generated huge returns over time. His 2020 research noted that 96% of stocks merely matched the return of one-month Treasury bills from 1926 through 2019. From that, one might conclude that the risk and expense of buying equities isn't worth the trouble. After all, only 86 stocks produced $16 trillion in wealth over that span. In fact, the professor's recent paper does seem to suggest that stock investing is futile, though it's more complicated than that. Looking at the CRSP database through the end of 2023, he found most stocks, 51.6% to be exact, lost money, with a median negative return of 7.41% over the 98-year span. But the average, or mean, return across all stocks for that period was 22,840%. In other words, $1 invested grew into that $229.40, owing to the outsized contribution of a few winners. Over that same span, inflation amounted to 1,614%, or 2.94% per annum. That 98 years included the crash of 1929, from which the Dow Jones Industrial Average took a quarter century to recover from. It also covered the fallow stretch from the peak of the 1960s go-go years, when the Dow first hit the magic 1,000 level, and the 1973 peak of the Nifty 50, through the subsequent so-called death of equities, until the liftoff of the great bull market of the 1980s, when blue chips would finally regain the 1,000 mark for good. While the majority of stocks lost money from 1926 through 2023, 17 stocks returned over 5 million%, turning a dollar invested in them into $50,000. The biggest return came from Altria Group, formerly Philip Morris, which turned $1 into $2.65 million during that time. Lottery ads tout $1 and a dream to lure punters with dreams of instant fortunes. But selling butts over time did better for investors, if not consumers, of tobacco. Runner-up was Vulcan Materials, which turned an investment of $1 into $393,492, according to Bessembender's analysis. Altria returned 16.29% per annum over those 98 years, while Vulcan, which sells crushed stones, sand, and gravel for construction, returned 14.05% a year. Those returns demonstrate, he says, that consistent but relatively modest returns from seemingly staid businesses can generate fortunes over decades. It shouldn't be a surprise that the headiest returns came from some of the Magnificent Seven megacap tech stocks. Among companies with at least 20 years of return data, NVIDIA, naturally, tops the standings with a 33.38% annual compound return from January 22nd of 1999 through 2023, during which $1 would have grown to $1,316 over the study's span. That doesn't include NVIDIA's spectacular 171.2% return notched in 2024. Other world beaters were number 3 Netflix, which returned 32.06% per annum from May 23rd of 2002 through 2023, growing $1 into $406.94. That was followed by Magnificent Seven member Amazon.com, which returned 31.87% from May 15th of 1997 through 2023, growing $1 to $1,551.73. The greatest total increase in a $1 stake among companies with a 20-year-plus track record was achieved by Home Depot, which grew $1 to $16,627.40 from its initial public offering on September 22nd of 1981 through 2023, a product of 25.87% annual returns compounded over more than 42 years. It would seem that these data demonstrate the wisdom of humorist Will Rogers' investment advice. Don't gamble, take all your savings, buy some good stock, and hold it till it goes up, then sell it. If it don't go up, don't buy it. By contrast, companies with the highest annual returns tend to fizzle quickly. Bessembinder cites Ascend Communications, which during the dot-com daffiness posted an annual return of 119.64% between May 13, 1994 and June 24, 1999, until it was taken over by Lucent Technologies. The lesson from his study would seem to be to stay invested in the market and let the winners run, which results in their having an outsized weight in an unmanaged index. Rebalancing to reduce the winner's outsized presence has been famously likened by the legendary Fidelity Magellan manager Peter Lynch to pulling out the flowers and then watering the weeds. That also means accepting extended periods of lackluster returns, such as periods following the 1929 and 1973 peaks. Recently, Goldman Sachs forecast paltry S&P 500 annual returns of 3% for the next 10 years. No less a long-term bull than Warren Buffett seemed to agree, building Berkshire Hathaway's cash hoard to over $300 billion. Still, history shows that sticking with stocks works over the very long term. Moving on to the Streetwise column, authored by Jack Huff, the headline reads, Chip Equipment Leader ASMLI's Ready to Bounce Back. The U.S. stock market wouldn't be riding so high without chip designer NVIDIA, which is the center of a flood of spending on artificial intelligence. NVIDIA, in turn, is deeply dependent on Taiwan semiconductor manufacturing, which runs the world's most sophisticated chip factories, and Taiwan Semi would be lost in cutting-edge chips without a Dutch company called ASML Holding, the leader in lithography, or using lasers and mirrors to print impossibly dense patterns on silicon wafers. All three companies have done wonders for investors over the past decade. NVIDIA shares have returned 29,000%. Taiwan Semi's American depository receipts 1,100%, and ASML's ADRs, which trade under the ticker ASML, 800%. But Nvidia and Taiwan Semi are trading close to their highs. ASML, after slashing its revenue guidance in October, is down by nearly a third from its peak last summer. Is this an early warning for chips and by extension the U.S. stock market? Or is ASML losing its monopoly hold on high-end lithography? Bet neither, and that ASML will bounce back. For background, start with Roy G. Biv, the old grade school anagram for the colors of the rainbow from red to violet. Red to violet. Colors are determined by wavelengths, and those are the ones that human eye are tuned to see, from 700 nanometers down to 380. But there are others. For example, beyond red is the infrared used by remote controls, and beyond that are broadcast signals, because long waves travel far. Old-fashioned television and now cell phones can use waves as long as meatball heroes, and AM radio waves can be the size of football fields. In the other direction, past violet, are extremely small waves that are handy for passing through solids, like the ultraviolet used in tanning beds, and below 10 nanometers, the X-rays that can reveal broken bones. This is the neighborhood where ASML plays. Its current extreme ultraviolet or EUV machines can print 13 nanometer resolutions, which chip makers can turn into even smaller features to achieve their current 7nm, 5nm, and 3nm nodes or generations. A nanometer is roughly how long a fingernail grows in a second. A human hair is 80,000 to 100,000 nanometers wide. Transistor density tends to double every 2 years or so, with a minimum increase in cost, making computers ever more powerful, a trend known as Moore's Law and kept alive today by ASML. Its room-sized machines are the most complex thing humanity's ever created, says Didier Sinama, who has studied ASML for decades and covers it for B of A Securities. For example, they fire lasers at molten tin droplets falling at a rate of 40,000 to 50,000 a second, 2 hits per droplet, without a miss. A stray particle could ruin a wafer or take down the machine. That technology took decades to develop. The first EUV test chips were made at SUNY Albany in 2008. The first commercial product to use EUV-enabled chips was Samsung Electronics' family of Galaxy Note 10 smartphones in 2019. China, which is banned from buying ASML's most sophisticated machines, would surely like to make its own. I think the odds of them being very successful in EUV over the course of the next 10, 15, 20 years are fairly low, says Simama. Beyond complexity, there are ASML's supply deals with Germany's Carl Zeiss, which makes the world's flattest mirrors, and Trumpf, which makes the world's most powerful pulsed industrial lasers. ASML's current top machines are estimated to cost more than $220 million. The next generation, called High Numerical Aperture, or NA EUV, can print 8 nanometer resolutions, supporting nodes starting at 2 nanometers. Intel is an early recipient. Broader uptake could start in a year or two at prices estimated at $380 million to $400 million per machine. Apple, which first brought 3 nanometer chips to market in the top 2023 iPhone, could move to 2 nanometer production around next Christmas. It currently leads the miniaturization push. Nvidia is content to lag a nanometer or two behind, while differentiating its chips with software and other add-ons. Back to our original question, why is ASML slumping? 3 reasons. First, China has rushed to stockpile lower-end ASML equipment ahead of what might be tighter trade restrictions starting soon. The shift back to lower demand from China will temporarily sap growth. Second, Intel made a bold push to expand in chip manufacturing with little financial success so far. Intel and Samsung have delayed equipment orders for their foundries. Third, despite strong growth in AI, there's a slump in consumer devices and their chips. 2/3 of the companies in the Philadelphia Semiconductor Index have trailed behind the S&P 500 index over the past year. A return to growth for ASML seems likely. Timing will depend on demand for phones, personal computers, cars, and gaming machines, as well as whether Intel and Samsung are able to lure Taiwan customers to their foundries. One bear case is that lithography intensity is rising more slowly than in the past. Taiwan Semi's 5-nanometer node uses 10 to 12 EUV layers, and its 3-nanometer node about 20. But with its 2-nanometer node, this is believed to rise to only 22 layers. On the other hand, older nodes will remain relevant for many years. The shift to high-NA EUV is coming, and computer memory is following the same rising EUV demand path as processors, adding to growth. B of A's Samama reckons that the earnings for ASML will grow at a compounded average of 16% a year over the next 5 years. Shares trade at 37 times this year's slashed earnings estimate, a premium, but one that's close to a 10-year low relative to U.S. chip equipment companies. J.P. Morgan points that out. My colleague Andrew Barry recently named ASML one of his top 10 stock picks for 2025, and Samama's price target for the ADRs implies 26% upside. Moving on, in this week's Barrons magazine to review and preview how online won Xmas. U.S. consumers spent a lot of time and money shopping online this holiday season, ringing up a record $241.4 billion from November 1st to December 31st, 8.7% more than last year, according to Adobe data. Half of that online spending came in 3 categories: electronics, apparel, and furniture and home goods. One reason? Big discounts. Electronics markdowns peaked at 30.1%, notes Adobe, and apparel at 23.2%. Consumers have been budget conscious for the better part of 2 years as they navigated persistent inflation and rising interest rates. Online shopping, however, made it easier to compare prices and grab the best deals, helping shoppers control expenses while offering the convenience of home delivery. In fact, while online shopping boomed, in-store sales struggled. Data from MasterCard Spending Pulse says that in-store sales increased 2.9%, while online retail sales surged 6.7%. Total consumer spending rose 3.8% year over year. As shoppers get more comfortable with buying online, they're experimenting with new tools and channels. Most online transactions, 54.5%, took place via smartphones this holiday season, up from 51.1% in 2023, Adobe says. Buy now, pay later tools also hit a high, contributing $18.2 billion in online spending, 9.6% more than in 2023. And, says Adobe, traffic from chatbots powered by artificial intelligence soared 1,300% from 2023. Now, imagine this year. That was reported by Sabrina Escobar. Last week, in the markets, the week began with a weak China manufacturing data, a falling yuan, and sinking stocks. U.S. stocks, powered by chips, edged up, then sold off as Treasury yields rose on strong jobs and services data. Los Angeles burned. Stock markets closed on Thursday for Jimmy Carter's funeral. The December jobs report on Friday saw an unexpected 256,000 jobs. Yields popped and stocks cratered. The Dow Industrials fell 1.9% on the week, the S&P 500 1.9%, and the Nasdaq Composite 2.3%. In companies, Meta Platforms named Trump ally and UFC CEO Dana White to its board and ended its fact-checking program. NVIDIA CEO Jensen Huang at the CES trade show announced new chips for gaming, autonomous driving, and robotics. The U.S. classified WeChat parent Tencent and battery maker CATL as Chinese military corporations. Stocks of vaccine makers Moderna and Novavax spiked after the first human bird flu death. Sports betting company Flutter Entertainment cut its outlook, saying too many favorites won NFL games. In deals, Walt Disney bought 70% of Fubo TV, which it will merge with its Hulu Plus live TV offering. Disney will pay Fubo $220 million to settle litigation over a sports joint venture with Disney, Fox, and Warner Brothers. Discovery, Nippon Steel, and U.S. Steel sued over President Biden's decision to block their merger. Cintas made a $5.3 billion offer, a 60% premium for uniform maker UniFirst, and Getty Images will buy Shutterstock for $3.7 billion. And this week, fourth quarter earnings season kicks off with big banks and brokerages announcing results on Wednesday, January 15th. BlackRock, Citigroup, Goldman Sachs, JP Morgan, and Wells Fargo all report before the opening bell on Wednesday. Bank of America and Morgan Stanley will follow suit on Thursday. The Bureau of Labor Statistics on Wednesday releases the Consumer Price Index for December. Economists forecast a 2.9% year-over-year increase in the CPI, 0.2 of a percentage point more than in November. The core CPI, which strips out the volatile food and energy prices, is expected to rise 3.3%, matching the November figure. The annual change in the CPI has ranged from 2.4% to 2.9% over the past 5 months, but getting to the Federal Reserve's target of 2% has proven to be a sticky problem. On Thursday, the 16th of January, Taiwan Semiconductor Manufacturing and United Health Group hold conference calls to discuss quarterly results. And the Census Bureau reports retail and food services sales for December. Consensus estimate is for a 0.6% month-over-month increase after a 0.7% gain in November. Excluding autos, retail sales are seen rising 0.5%, 0.3 of a percentage point more than previously. And what were the numbers? 2.4 million. The average daily number of cyber attacks targeting the Taiwan government in 2024. Double that of 2023. 1.6 million. That's the number of Americans job hunting for at least 6 months, up more than 50% since 2022. 686. The number of U.S. companies that filed for bankruptcy in 2024. That's up 8% from 2023 and a 14-year high. 285%. The rise in the U.S. government's annual net interest costs over the past decade to $882 billion in 2024. Moving on in the Barrons of January 13th of 2025, How Home Insurers Will Fare After the Wildfires by Bill Alpert. Property and casualty stocks have taken a hit, but rising climate change risk means a rising need for insurance coverage. Watching Pacific Palisades burn, it may be hard to imagine the insurance industry surviving the blaze, but the severe weather of climate change could actually help the industry grow. So send relief to wildfire victims, but don't sell your insurance stocks. By Friday, shares of property and casualty insurers were reeling from forecasts for $20 billion in losses from the Los Angeles suburbs firestorm. Mercury General stock was down 24% on the week, Allstate was off 5%, and Traveler Companies 4%. Those are short-term hits. The long-term picture for the insurance industry is brighter. Through the past 5 years of hurricanes and fires, insurance stocks have outpaced the S&P 500 index, with the iShares U.S. Insurance Exchange Traded Fund rising 87%, compared with an 80% advance for the index. That's because the industry has been able to raise premiums and have the discipline to avoid pursuing business where it can't operate profitably. Many publicly held property and casualty insurers reported record profits in 2024. The top home insurers in California are State Farm Group and Farmers Insurance Group, with respective market shares of 21% and 16% in 2023, according to state figures. They're both mutual insurance companies, which means they're owned by their policyholders and not the investing public. They both stopped writing new policies in the state 2 years ago after regulators refused their request to raise premiums. Among publicly held property and casualty insurers, those deriving the largest portion of their California premium revenue from homeowners policies include Mercury General with 23%, Allstate with 15%, and Travelers with 13%. Mercury announced on Friday that it expects its losses to exceed the $150 million it must swallow before its $1.3 billion in reinsurance kicks in. Warren Buffett's Berkshire Hathaway is the state's third largest property and casualty insurer, but less than 1% of its premiums come from homeowners insurance. Wildfire losses haven't been material enough to rate a mention in its insurance results since 2020. Climate change increases risk, Buffett told shareholders at Berkshire's May 2024 annual meeting. In the end, it makes our business bigger over time. Rising risk means a rising need for insurance coverage. If there was no risk, there would have been no insurance business, said Buffett. Most of the insurers' contracted liabilities, especially in reinsurance, are limited to a year, pointed out Berkshire's insurance chief Ajit Jain. Then it can reprice or get out of the business altogether. Climate change, much like inflation, done right, can be a friend to the risk bearer, Jain said. California provides a preview of how the insurance world is changing. The Golden State has the most wildfire losses, and it has had regulators reluctant to let insurers raise premiums to compensate. So insurers have been pulling out of the state, leaving homeowners to seek expensive state-sponsored coverage. Even before the Palisades disaster, California regulators were beginning to give way. They're waking up to the fact that the insurance carriers need to make some kind of a return, a decent return for us to keep deploying our capital, Jain observed at Berkshire's May gathering. Starting this month, California will allow some price increases, while requiring them to continue coverage in areas at risk of wildfire. In anticipation of the regulatory change, Farmers said on December 11th that it would start writing new California policies. Mercury General said it would become the first major insurer to write new homeowners insurance in Paradise, California since 2018, when that town was engulfed by the Camp Fire conflagration. Barrons asked Farmers if the latest wildfires making it reevaluate its return to homeowners policy writing, and the answer is no. We're currently focused on assisting customers who are impacted by the devastating fires and strong winds affecting Southern California, says a spokesman. The information that's found in our December 11, 2024 release about increasing coverage availability in California remains accurate. To cope with more frequent payouts due to climate change, primary insurers have had to spend more money on reinsurance, which kicks in after certain loss levels. That's been a boon for Berkshire, Arch Capital Group, and Everest Group, while lifting the overseas shares of Swiss Re and Munich Re. We remain committed to providing natural catastrophe capacity across all markets, says a Munich Re spokeswoman, as long as we can achieve prices that adequately reflect the risk. When insurers withdraw from states with rising climate losses where regulators don't allow premiums to rise, some have looked to provide excess and surplus lines, which cover hard-to-insure properties. The demand for excess and surplus coverage in states like California and Florida convinced Morgan Stanley to make Ryan Specialty Holdings a new buy recommendation when the broker launched research on specialty insurers in December. States where insurers are reducing admitted market exposures tend to have large exposures to the E&S market, wrote analyst Bob Gian Wang and his colleagues. Climate change is changing the insurance business. For policyholders, buying insurance will be more expensive, but for those with capital and savvy, supplying insurance will become a bigger business. Moving on in this week's Barrons magazine, climate scores for homes are the new big number. Listings websites such as Zillow have tools that let buyers learn about their dream home's risk of flood, fire, and wind damage. By Shana Mishkin. Forget about square feet and the number of bathrooms. Home buyers now will also be asking about the weather. Many people move to areas endangered by extreme weather events because the lifestyle and cost of living outweigh the risks. But that's changing, with soaring insurance costs, 2 recent devastating hurricanes, and now the ferocious wildfires in Los Angeles underscoring the issue. Home listings giant Zillow Group is rolling out climate risk estimates that size up a home's likelihood of damage from flood, fire, and wind over the next 30 years. These scores, along with soaring insurance costs, could change the economics of where people choose to live as buyers avoid homes with high risk or face fewer bidding wars to buy them. Hurricanes Helene and Milton, which separately hit the Southeast last autumn, caused up to $81.5 billion in combined insured and uninsured losses, according to estimates by CoreLogic, a property data and analytics provider. We've seen this massive move of people since the pandemic from the Northeast and Midwest into Florida, says Moody's Analytics chief economist Mark Zandi. That now's in jeopardy because of the threat of storms like this and what it means for the cost of owning a home. A house's risk of flood or wildfire usually isn't as apparent at first glance as an ugly bathroom or a cramped kitchen, but now Zillow is joining home listing websites like Redfin, Realtor.com, and CoStar Group's Homes.com by adding scores provided by climate risk modeling company First Street. News Corp, which owns Barrons, also owns Realtor.com operator Move. Zillow may not be the first to add First Street's scores, but it's the largest, with 233 million average monthly unique users. That means its rating system will be seen by many more people. Zillow users can find a listing's score about halfway down the page on its website, underneath its payment calculator section. Not every home has a score. First Street builds models based on historical data, climate projections, and statistical analysis to determine the probability that a property could see flooding, wildfire, dangerous winds, or other detrimental weather-related events, even if it hasn't in the past. On listings websites that use this data, it appears as a score from 1 to 10 across 5 risk categories. For people who exclusively use Zillow, this will be the first time they really have seen this information, whether it's on their property or in the search process, said Jeremy Porter, head of climate implications at First Street. Homes with better climate scores could become more sought after, while those with worse readings could see lower prices, according to a National Bureau of Economic Research working paper co-written by Redfin's chief economist Daryl Fairweather and researchers from the University of Southern California, Columbia University, and the Massachusetts Institute of Technology. To test the impact of risk scores, Redfin displayed First Street's flood ratings to some users but not to others. The information changed some users' behavior on searching and buying, Fairweather says. Compared with a control group, users who viewed homes with high risk scores instead made offers on properties that were about half as risky. The scores also drove up competition for less risky homes, increasing prices slightly and reduced demand for some high-risk homes. The flood risk information had a tangible effect on property prices, with homes in high flood risk areas experiencing a decrease in value, the authors wrote. The tool isn't the only way that prospective buyers can learn about their dream home's weather risks. The Federal Emergency Management Agency, FEMA, also maps potential hazards through its National Risk Index and maintains maps that designate which homes require flood insurance. A buyer should consider First Street scores as a starting point for further research, says Colin Wainwright, president of the Greater Nashville Realtors Board of Directors. I would encourage consumers to use it as a guideline to then ask more questions about a property, she says. Talking to your homeowner's insurance agency or broker is going to give you a much clearer, much more accurate picture of what the risk is for that particular home. Insurance is an issue that increasingly is tied to climate risk. In fact, rising premiums are the first way many homeowners feel the impact of storm risks, says Ben Keyes, a real estate professor at the University of Pennsylvania's Wharton School. Getting any sort of credible information about a property's climate risk is a big step in the right direction, says Keyes, who co-wrote a separate National Bureau of Economic Research working paper on climate risk and property insurance last year. Keyes' research found that premiums rose 33% from 2020 to 2023, with those climbing sharply in areas that FEMA deems to be at higher risk. In the long run, climate risk could alter migration patterns, but consumers don't need to dismiss an area solely based on an area's risk rating. It's cheaper to pay to make a home more resilient than to replace it after disaster strikes, notes John Rogers, Chief Data and Analytics Officer at CoreLogic, which sells an analytics tool that helps insurers size up the resilience of individual houses in storms. A person's home is the biggest way that Americans make wealth, he says. It's definitely worth protecting. Our next headline in this week's Barrons of January 13th, 2025, what 2024's top stock funds are buying now. In a tough year for stock pickers, a handful of funds managed to trounce the market. Here's how they did it and what they like for 2025. This is reported by Ian Salisbury. It isn't surprising how some of the best actively managed mutual funds of 2024 trounced the market. What they'll do for an encore in 2025 is more of a mystery. In the large cap space, the winning ticket was simple. Bet on the Magnificent Seven, companies like Nvidia, Apple, Alphabet, and Microsoft that accounted for more than half of the S&P 500 index's total return. Those stocks show up heavily in funds that topped the large cap category. Funds that didn't tag along with the Magnificent Seven lost out. While the S&P 500 gained 25%, including dividends, the average large cap fund returned 21%, and just 25% of large cap managers beat the market, well below the annual average of about 40%, according to Morningstar. Small and mid-cap funds, which didn't have to contend with the Mag 7s distorting their benchmarks, fared better. The average mid-cap fund returned 13.4%, nearly 2 percentage points behind the Russell Mid-Cap Index of 15.3%. Actively managed small-cap funds returned 11.3%, closely matching the Russell 2000 Index. Beating the market in 2025 may prove tougher. Structural market risks are now elevated, including steep valuations in large caps and a historically high concentration in the tech and communications sectors at 41% of the S&P 500. Stocks bled upward all year. Unless something's real cheap, you might want to wait for a pullback, says Michael Cugino, member of the Permanent Portfolio Aggressive Growth Fund, one of the year's top performers in the large cap space. Get your shopping list prepared and wait for the right moment. How the stock market will mesh with Donald Trump's presidency and economic policies also remains unknown, and the bond market will play a role. Yields have been inching up as hopes dwindle for interest rate cuts in 2025. That affects stocks by depressing multiples, and it tends to hit stocks with the steepest valuations the hardest, though it has ripple effects through banks and other rate-sensitive sectors. Large cap managers are now in a bind. Many are clinging to Nvidia and other tech names, but those stocks have become highly crowded trades, leaving fewer incremental buyers and more potential for losses if selling pressure picks up. Some skittishness may already be emerging. Volatility has picked up, and the tech-heavy NASDAQ composite is down about 3% from its mid-December high. Where do the winning fund managers see value now? Barrons talked to several top stock pickers to hear their ideas. Along with the artificial intelligence theme, many see bargains in segments such as beaten-up energy and materials stocks, construction services, banks, and travel companies. A note about our list of winners. Barrons screened for funds with the top 2024 performance in their Morningstar category. We included only funds that are open to new investors and have at least one retail share class. Without those criteria, other funds might have come out on top. We also didn't screen funds by asset size or expense ratio. Many funds on our list have expense ratios well above Morningstar's asset-weighted average for active funds of 0.59%. High-fee funds are at a big disadvantage at consistently producing market-beating returns. Here's a look at some of the winning funds and their stock ideas for 2025. Permanent Portfolio Aggressive Growth is our first. Cogino has run this $44 million fund since 2003. Typically holding about 40 stocks. The fund lives up to its name as a permanent portfolio, often holding stocks for decades and rarely making changes, with an average turnover rate of just 12% a year. That makes it highly concentrated compared with the S&P 500 and prone to deviating sharply as the market shifts. When it does well, however, it shines, gaining 44.5% in 2024. Cogino did that in good measure by holding a large slug of the fund in tech, 41% as of November of 2024, with 17% in NVIDIA, a stock he first bought in 2019. Other tech winners in the fund include Broadcom and Palantir Technologies. We still like the companies, he says, adding that they're generating solid revenue, cash flows, and earnings in markets with plenty of growth potential. Selling the stocks would also trigger capital gains for investors, something that Cogino tries to avoid. Beyond tech, some other investments paid off, including Costco Wholesale and Williams-Sonoma, both longtime holdings of the fund. One of Cogino's more contrarian ideas for 2025 is copper, via shares of mining company Freeport-McMoRan. While he's held the stock since 2010, it's now in his top 5 holdings. Copper prices are closely tied to economic growth in China, which could get a boost from a recent round of stimulus, he says. While copper and other commodities have been hurt by the strong dollar, he sees that as a short-term concern. Copper is involved in so many manufacturing processes, from real estate to green energy and other newer industries. The demand is there, Cogino says. He also likes financials and is investing in Morgan Stanley, Charles Schwab, and State Street. Money managers he thinks will thrive in this market. If the economy grows and these companies build protective balance sheets, they're great total return businesses over the long term, he says. Cogino's strategy can be inconsistent. While he beat 99% of peers in 2024 and 2023, he posted a 26% decline in 2022, trailing 99% of peers. Over the past 15 years, the fund's 13.9% average annual gain matched the S&P 500's return. The next, Bridgeway Aggressive Investors 1. The $204 million Bridgeway Fund holds 86 stocks, all of which emphasize one of 3 characteristics: value, quality, or sentiment, the last measured by elements like positive earnings surprises and price momentum. A large bet on tech helped the fund deliver a 35.8% return through top holdings NVIDIA, Microsoft, Apple, and AppLovin. While tech remains a big allocation of the fund, co-manager John Montgomery sees value in other areas, including travel stocks like Expedia and Royal Caribbean. These companies got hammered during the pandemic, and now we've come out of it and people want to travel, he says. Wall Street hasn't fully priced in their potential. Montgomery sees bargains in regional banks such as East West Bancorp, First Horizon, and Webster Financial. All trade below 13 times next year's earnings and should get a lift from deregulation, which could help reduce costs and improve sentiment on bank stocks. Consolidation in the industry may also be coming, making smaller banks buyout targets. Despite holding nearly 30% in tech, the Bridgeway Fund is more of a value play. Its price-to-earnings ratio of 16.6 is well below the market average of 22. Some of the deeper value stocks in the fund include Johnson & Johnson, General Motors, Molina Healthcare, and Builders First Source. The fund's recent winning streak hasn't saved it from underperforming the market long term, returning an average 10.5% over the past 15 years. Spirit of America Large Cap Value is the next fund. NVIDIA, Apple, and Microsoft helped this fund return 33.3% last year. None was a recent purchase. It's held NVIDIA since 2017. We look for quality companies, and when we see value in it, we're definitely going to hold it, says co-manager Douglas Ravello. Like other large cap winners, this fund is sticking with tech, which was 36% of the portfolio as of November. Ravello also likes utilities such as Constellation Energy and Vistra as bank shots on tech. The utilities own nuclear plants that stand to benefit from AI's enormous energy appetite. Neither stock is cheap anymore, with Constellation at 28 times estimated 2025 earnings and Vistra at 23 times. Ravello is unfazed. With data centers and the need for power and clean energy, it's the direction we're going, he says. We see demand for it. Though the fund is following the tech trend, it's a generally stable portfolio of 148 stocks, with annual turnover of just 5%, according to Morningstar. Some of the fund's additions in 2024 included CrowdStrike Holdings, Vistra, and Meta Platforms. Spirit's big win in 2024 has helped its 5-year average return beat 96% of peers, though it trails the market in large cap averages on a 15-year basis. One drawback, a steep annual expense ratio of 1.53%. Schwartz Value Focused Fund. If you think that Texas oil and natural gas have value, and energy more broadly, this fund is for you. Its biggest holding at 38% of assets as of November 2024 is Texas Pacific Land. That fund started buying it in 2021 and it has notched gains of more than 400% on the stock, which now trades around $1,250 a share, following a 115% gain in 2024. TPL owns 873,000 acres, mostly in the Permian Basin, a hub for oil and gas drilling. It earns money from royalties, surface leases, and water for drilling and disposal activities. More production means more royalties, and the company is invested heavily in water, earning royalties on more than 1 billion barrels in 2024, worth about $100 million in revenue, most of which is pure profit, the company says. TPL is also looking to lease land for data centers and has other growth initiatives. The stock is now pricey, with a P/E ratio of 63. But George Schwartz, who runs the $53 million fund with his son Timothy, isn't deterred. It has tons of cash, no debt, and practically no operating expenses because of the nature of its business, he says. TPL isn't the fund's only energy bet. The sector accounts for 65% of its assets, including companies like Devon Energy, Occidental Petroleum, and SLB. A lot of investors seem to think that energy produced by oil is going to be a thing of the past, Schwartz says. I think that's wishful thinking. The fund has managed to defy lackluster returns in energy, thanks largely to TPL, which will have to mount another solid year for the fund to do well, assuming the Schwartzes don't sell. The fund's 12.7% return over the past decade beat 99% of rivals, though its 15-year return is below average, according to Morningstar. While it topped the charts last year, it trailed 99% of peers in 2023 with a 1.2% return. And then there's Hennessy Cornerstone Growth Fund. This small cap champion takes an unusual but methodical approach. The $559 million fund owns 50 stocks, which start at weightings of 2%, but are allowed to drift higher or lower. It screens for stocks with a price-to-sales ratio below 1.5 and an improving profit picture, then buys the ones exhibiting the biggest price momentum. Co-manager Josh Wine attributes 2024's banner year to a few tech holdings, including Supermicro Computer, which the fund sold last spring before accounting issues hammered the stock. Another winner was electronics manufacturer Celestica, which finished the year up more than 200%. Construction services is now a major emphasis, including stocks such as Tutor Perini, IES Holdings, and MCOR. Wine says that industry has big potential for 2025 thanks to more onshoring of manufacturing, which Trump is likely to encourage. CEOs also continue to fortify supply chains against disruptions, he notes. Just-in-time delivery sounds great in business school, he says, but in an emergency, efficiency goes out the window. The fund is far more exposed to industrials, at 30% of the portfolio, than tech, while healthcare makes up 15%. Those are relatively cheap sectors, helping to keep the portfolio's P/E ratio at just 12.4. While it doesn't hold many household names, its value and momentum formula has paid off. Its 11.8% annualized return over the past 15 years beat both the market and 94% of rivals. And we'll close with Barrons Roundtable. One roundtable, two crystal balls. That's our assessment of 2025's Roundtable, which featured a large group of bearish panelists and a smaller but equally committed cadre of bulls. It's hard to recall a year in which our panelists' views were so neatly divided, but then it's hard to recall a January buffeted by so many economic cross-currents. First to the bears, who expect 2025 to be far more challenging for the markets than 2024, which saw the S&P 500 index gain more than 20%. Why the gloom? Look to levitating bond yields, which reflect fears of resurgent inflation, and levitated equity valuations, which have left the stock market priced for perfection. The pessimists worry as well about the inexorable growth of government debt and the policy uncertainty that attends any change in Washington, D.C., especially the sea change promised by incoming President Donald Trump. The optimists, on the other hand, expect stocks to keep rising, powered by a strong economy, double-digit earnings growth, government deregulation, and an ensuing wave of mergers and acquisitions, as well as the widespread adoption of artificial intelligence by companies not only large but medium-sized and small. The price action may be choppy, they say, but the ingredients for more gains are, or soon will be, in place. This roundtable met January 6th in New York with the day divided as usual between the 11 panelists' discussion of the macroeconomic backdrop and their favorite investment ideas. Ironically, for all the negativity of the morning session, most of these investment pros offered up more stock picks than usual, which suggests that the market may be overpriced, but many stocks are cheap. This week's roundtable installment, the first of three, includes an edited version of the macro debate and the investment recommendations of Abby Joseph Cohen and Scott Black. Abby, a former Goldman Sachs strategist and current professor of business at the Columbia University Graduate School of Business, highlights 2 bargains in Japan and 3 in the U.S., while Scott, founder and president of Delphi Management, combs the small cap market for a handful of unloved gems. And with that, we've come to the end of our reading of Barrons, the issue of January 13th of 2025. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially those we've lost recently. Bye for now.